Howdy, Jacob here. Today we're looking at the buckle, ticker symbol BKE. I remember seeing this on the Magic Formula when I ran it a little bit ago. So I guess I'm already a little biased towards it. We'll see where the price valuation ends up, though. We see a 3.76% dividend yield. They're in the specialty retail industry, 1.9 billion on market cap with a 1.5 billion dollar enterprise value. So net debt is actually negative, meaning that more cash on hand than debt. Let's look at that quick. And we can agree to that. So no long-term, short-term notes payable, whatever, but they do have 215 million in capital leases and 252 million cash on hand, 21 million in short-term investments. Very healthy balance sheet, very positive from that perspective. As for growth, we're not looking at much here. 1.1 billion in 2014 and then 1.3 billion in 2023. So we're not expecting a whole lot of growth here, but we do see a massive return on invested capital. It looks like if they were to be able to invest into an endeavor, they'd get a massive return on that investment. Margins are both up, 44.3% gross margin to 50.3 2023. Then 10 years ago, 22.8% operating margin up to 24.4% 2023. They have been paying a dividend all 10 years. Okay, let's look at the free cash flow statement. We see that capital expenditures are very low in relation to the cash from operations, so that's great to see. Their 5-year average free cash flow is probably about 200 because that 200 million. That includes about a 294 million in 2022 and as low as 99 million in 2019. So let's say a 5-year average of 200 million, and their aggregate payout is actually 203 million. But that's their main use of cash flow. It's really all going towards a dividend. So that's interesting. I mean, we have no investments, no share repurchases, and they don't have any debt. So although I mean it's interesting to see these types of companies. I mean, leverage can help a company. It's not it, in most cases it's probably pretty smart to put a little bit of leverage just to invest in certain things, especially when your return on invested capital is as high as theirs is. If they can find things that they can invest in, they'll do a fantastic job at it. But historically, probably 90% of their dividend or 90% of their cash flow has gone towards a dividend and really nothing else. And so to me, I'm going to be a little bit concerned, to be honest, say that they cut their dividend in half, which will have about, or let's say times 2/3. So they're going to cut their dividend by a third, and that payout ratio is still going to be 60% of their 5-year average free cash flow. But then they'll have more money to buy back shares when your stock looks stupid cheap. We want you to be buying back as many shares as possible. And then if you find invest things to invest in, it'll be nice to have that capability on your free cash flow to invest in those things. I know you have 250 million in cash on hand, and then even with your short-term investments, you're really looking at about 273 million cash-like equivalents with no debt. But I think it will be good to have a little bit of wiggle room if things go bad. I know that having cash on hand is helpful for dividends, but to me, I want them to start having the capability to buy back shares if the stock gets stupid cheap, and then invest if they find a great thing to invest in, since their return on invested capital is so great. So I think I'm ready to make some assumptions here outside of that dividend. The only thing is, if I cut that by a third, then we're looking at a high 2%, a 2.7% dividend yield, which is still very high, but it's not the 4% that we're looking for in the screener. So keep that in mind. If they keep it where it is, it's still just under 4%, but I want the company to really start thinking about other ways of managing, allocating cash that are most advantageous to them. And their margins have been going up, but I'm still going to do roughly 5-year average. So let's do 15, 17%. And then revenue change, probably not a lot of growth here, 2. And then probably little growth at the end of 7 years. Share change, they'll probably they haven't really issued shares, but they'll, um, yeah, maybe slight issuance, slight stock-based compensation. But I did see also their insider ownership was about 40%. That's another big positive here. The management's likely going to do what's best for the business, but maybe the management just doesn't know how to allocate their cash properly. This would be a great time to, maybe invest a little bit in consulting to really try to allocate that cash, or just hire somebody who's historically been very good at allocating cash, since paying a dividend can be good for investors who just want that excess cash flow from owning a stock. But in terms of maximizing returns, it'll definitely make more sense to better allocate cash towards uh, debt, share repurchases, whatever. So to me, my final estimation gets us to a price that needs to fall 37% before you get a 15% return. Given these assumptions, I think I'm fine with these assumptions. I think it is a solid dividend stock. I think that although I'm predicting them to cut it, it's really just so that they can use outside other uses of cash flow. And so to me, if the stock falls 37%, but they cut their dividend a little bit, you're still probably looking at close to a 4% dividend yield. But definitely an interesting company. I think it's worthy of being on your screener, although it doesn't necessarily hit that 4%. It might hit another screener that you're doing. But hopefully everyone enjoyed the video and learned something. That's a great rest of their day. Thank you.